Hi, welcome back to Tony Talks Money. Today I'm going to show you 5 powerful ways to buy property with little or no money down. Yes, it's possible. And no, it doesn't involve winning the lottery. Whether you're just getting started or you're looking to scale your property portfolio, these strategies could save and make you tens of thousands of dollars. Stick around till the end because I'll also tell you about 10 more advanced strategies I'll cover in upcoming videos. Let's jump in. First up, adding value. To increase a property's value, consider improvements like updating the kitchen or bathroom, redecorating, new flooring, adding an extension, converting the loft or garage, or enhancing the garden and curb appeal. By the way, you don't need to spend a lot of money on new kitchens or bathrooms. If you spend too much, it won't increase the value very much. Most kitchen units are made of MDF, so very few of them are solid wood anyway, even the very expensive ones. I knew a couple who spent $80,000 on a kitchen, which included making it open plan by getting rid of the separate dining room. It didn't add $80,000 to the selling price. At most, it added $40,000. Personally, I would have kept the dining room, but converted it into an extra bedroom. That would have cost far less, but added more value. Generally, buyers will pay more money for houses with more bedrooms than ones with fancy kitchens and bathrooms. Probably the only exception to that is if you're going to live it in it as your own home, I suppose. I once bought a 4-bedroom house with a large double garage. It's an investment property. It had 2 surplus reception rooms downstairs. One was a study and the other was a dining room. But, get this, the kitchen was large enough for a large dining table anyway. I converted both reception rooms into bedrooms and installed a dining table in the kitchen. I also added en-suites to 3 of the bedrooms to add to the ensuite in the main bedroom. That left the house with 4 en-suites and 1 shared bathroom with 2 bedrooms either side of it that obviously didn't have an ensuite. This increased the value of the house by more than $100,000 above the cost of the refurbishment. I was also able to let out 6 bedrooms to 6 separate tenants rather than to 4 individuals or to a family. So my rental income increased by 50% as well. I have not yet converted the large double garage. I would convert it into at least 2 bedrooms, probably 4 bedrooms if the roof were raised. I estimate that would increase the value of my property by at least another $100,000 and increase the rental income by a further 2/3 or 66%. The only reason I haven't done this yet is because the drive is a shared drive with one other property which owns about 80% of the drive. So there isn't enough parking spaces at the moment. I plan to offer to buy 30% of the drive, leaving us with 50-50 ownership of the drive between myself and my neighbours. I can then convert it into a 10-bedroom house. Now let's talk about using other people's money, or OPM. Borrow money from private lenders short-term to buy property. Security can be in the form of a personal guarantee only. Some private lenders may insist on a first or second charge on the property, but usually a personal guarantee is sufficient for most private lenders. The interest rate will likely be higher than the mortgage rate, but usually cheaper than bridging finance, which can cost 20% or more a year. However, you only usually borrow this money short term to finance the development of the property before you refinance it with a high street lender at a much lower interest rate. You would typically pay about 10% interest to a private lender, though it does vary, it can be between 6 and maybe 12%. Have a clause put into your loan agreement to allow the loan to be renewed after, say, 12 months if the development gets delayed for any reason. Usually I find lenders are quite open-minded about this. There are mainly 3 sources of private lending: your relatives, your friends, and your acquaintances. Make it easy for yourself and ask your relatives first. starting with your immediate family. They are the people who trust you the most. Then ask your friends. Last of all, ask your acquaintances. First, you will feel uncomfortable asking people to lend you money, especially if you were taught by your parents to not borrow from relatives or friends. After all, even the great bard Shakespeare, no less, wrote about it in Hamlet in 1602. Neither a borrower nor a lender be, for loan oft loses both itself and friend, and borrowing dulls the edge of husbandry. But it's little wonder that most people don't like asking people to lend them money. This is something you have to do if you want to get on in property investing. You have to get out of your comfort zone. Otherwise, you'll just be like everyone else and not succeeding in life. One way to approach it is to ask the person you want to borrow the money from if they know anyone who would be willing to lend you money to fund a property project. By not directly asking that person, you won't be embarrassed, and you may well find he or she volunteers to lend you the money themselves anyway. It's critical that when you discuss the project with the prospective lender that you have full knowledge of the project, you know all your facts and figures, how much you're going to spend, how much it will be worth when it's sold, and how much profit you will make. Be enthusiastic and confident. Do your research and know your facts. That way you will be more convincing to the lender. Strategy number 3, lease extensions. A lease extension allows leaseholders to add years to their existing lease, potentially increasing the property's value and providing greater security. This can be done either informally through an agreement with the freeholder or formally through a statutory process. You'll have to appoint both a solicitor and a valuer. Usually, the cost of the lease extension, known as the premium, is far lower than the increase in value of the property after the lease has been extended. So it's what I would technically call a no-brainer. If the property has less than 80 years left on the lease, its value is lower and will continue to decrease in value. Also, it becomes more difficult to get a mortgage the shorter the remaining term becomes. I own a leasehold apartment which is worth £200,000 with 75 years left on the lease. I was only able to remortgage it based on a value of £200,000. So I applied to the freeholder for a lease extension. The freeholder agreed to a 90-year lease extension for a fee of $11,250. I have to pay associated legal, valuation and housing association fees totaling around $2,000. However, my apartment will be valued at $250,000 after the lease extension. This means I can borrow $37,500 more, which will mean I can take $24,250 cash out of the deal once the lease extension has been completed after paying off those fees. Strategy number 4, leveraging existing equity. If you already own property, you can potentially leverage its equity to secure a loan for a new purchase, effectively using the equity as a deposit. This technique is available for the more established property owner. You borrow money as a further advance against your existing property or properties as a second charge, and use the money to fund the mortgage fees, valuer's fees, legal fees, stamp duty and deposit. Alternatively, you remortgage with a new lender. The interest rate will be a competitive buy-to-let rate, and it will be what's known as interest only, no capital repayments. I used this technique a year ago by taking out a further advance with my existing lender on my main residence. It's a second charge mortgage on an interest-only basis. I used the funds to pay for the deposits and associated costs to buy 3 investment properties, all apartments. Realistically, this sort of approach is only really available for you if you've built up significant equity in your main residence. In my case, I did this after 9 years of ownership. But really, if you're borrowing a smaller sum, you could probably do it after 2 or 3 years or after you've added value to the property. I've also taken out a second charge loan on 4 of my buy-to-lets by borrowing the money from a specialist lender. The only downside of this approach is that the interest rate you pay is usually a lot higher, and the lender may require you to repay the loan on a capital and repayment basis, which is a lot more expensive than interest only. And finally, mortgages and loans. Explore mortgage options, including buy-to-let mortgages, which can cover a significant portion of the purchase price, leaving you with a smaller deposit to find. You cannot borrow more than 75% of the purchase price to buy an investment property, which means you have to fund the 25% deposit, legal fees, lender's fees, and stamp duty. If you do not have the spare funds, then you can use any one of many ways to fund the deposit. Some specialist lenders may be prepared to lend you the full amount to buy a property if you can prove the value will be significantly higher by the time you exchange contracts and before completion. For example, if you use the title split strategy, which I will explain in my next video, and can get a valuation of the property post title splits, after exchange of contracts and before completion, then certain lenders will advance you a mortgage based on the future valuation of the property after the title splits. I must emphasize this is a rare case of being able to borrow more money than the property is marketed at. Usually, a lender won't lend you money based on the future value of the property, but instead they will lend you up to 75% based on the purchase price or valuation, whichever is the lower. You will not be able to remortgage or take a further advance from the same lender for at least 6 months. One way in which you can secure a higher mortgage on a property is if the lender accepts the loan is for a property-based business, such as an HMO, we call it, houses of multiple occupation, or otherwise known as bedsits, single rooms let out to individuals in a house. The lender will lend you money based not only on the value of the building, in other words, the bricks and mortar, but also the value of the business. So once you've bought the property using a normal buy-to-let mortgage, you could potentially remortgage it after 6 months as a business loan, in which case you'll be able to release the equity in the property to effectively repay you your deposit and other costs, or at least a high proportion of them. This works particularly well if you've developed the property as well and added extra value. Another way of borrowing more than 75% is to buy a commercial property and develop it, such as by adding extra floors as a rooftop development, say, of a block of apartments. The lender will typically lend you up to 60 to 70% of the purchase price as a commercial mortgage. However, the lender will usually lend you 100% of the development cost. Now, they won't give you the money straight away. These funds are released in stages during the build, and usually it'll be typically, say, 3 stages, depending on which stage you've got to. Once the development has been completed, you can get the building revalued to achieve what's called GDV, its full market value, then remortgage with a high street lender at normal commercial mortgage interest rates. The development loan is interest only, and it's deferred until the development is complete. This preserves your cash flow, but I must warn you, the interest rates are quite high, typically 20%, but remember, this is only going to be during the development phase, so maybe 9, 12 months, 18 months if you're unlucky. So there you have it. 5 ways to buy property with little or no money down. Add value, use other people's money, lease extensions, leverage your equity, creative mortgage and loan options. In the next 2 videos, I'll show you 10 more advanced techniques to fund your property deals. So make sure to subscribe and hit that bell icon so you don't miss out. Thanks for watching, and I'll see you in the next one.